Welcome back to Investing Talk Podcast. Today, we're dissecting a company that's, well, it's become quite a battleground for investors, asset entities. You've got its current financials painting one picture, but then the market's recent moves, they seem fueled by this really dramatic strategic pivot. Tells a whole different story. So we're asking the crucial question, is now a good time to buy asset entities? We've sifted through, all the latest reports, financial filings, market insights, trying to give you the clearest possible view. Our mission, like always, is to cut through the noise, give you the really important nuggets of knowledge, help you understand the full picture so you can walk away feeling well-informed. And hey, if you're finding value in this analysis, please take a moment to subscribe, maybe like this episode, leave a comment. Your engagement really helps us bring you more of this kind of analysis. Oh, and if there's a specific company you'd like us to look into for a future discussion, just drop its name in the comments below. You can also support us by considering buying us a coffee every little bit. It helps us keep the lights on and the research coming.
Okay, let's unpack this asset entities situation. Generate a lot of buzz, right? But when we actually strip away the hype, look at the numbers, what do we really find? Let's maybe start with the basics, the foundational elements. What story do their financial statements tell us about the core business before we get to the big news?
Yeah, that's the right place to start. And what's truly fascinating here is that the company's reported financials for fiscal year 2024, they show some really clear, pretty challenging patterns. You look at revenue growth, it's been modest, $1.16 million. Okay, that's a slight increase from $1.09 million the year before, fiscal 23. But, and this is critical, they reported a net loss of $3.48 million. That actually got worse from the $2.95 million loss the previous year. So you're looking at deeply negative profit margins and an accumulated deficit. It clearly indicates they've been unprofitable for quite a while. Ongoing unprofitability.
And I saw something about going concern language in their filings. That sounds like a flashing red light for investors. What exactly does that phrase mean?
It absolutely is a red light because it's the company itself acknowledging, material doubts about its ability to continue operating without getting more financing. Essentially, they're telling you their very existence is questionable if they can't bring in more cash.
Wow. So the company is openly admitting it needs more cash just to survive. Okay, what does that mean for their balance sheet then? Their cash flow? Are they just burning through reserves?
Yes, they are. Pretty significantly. As of March 31st, 2024, asset entities had about $1.84 million in cash left. Now, on the plus side, their long-term liabilities are minimal, so the balance sheet is relatively unlevered, not much debt. But they burned through $3.14 million just from operations in fiscal 2024 alone, and their filings state this reliance on frequent equity issuance, meaning selling more shares to fund operations. That's a stated risk, and it's ongoing.
Which dilutes existing shareholders, right?
Exactly. This continuous cash burn means they constantly need more capital just to stay afloat. It's a tough cycle.
Okay, so financially, it really sounds like they're in a tight spot. Let's back up a bit. What exactly is their core business? What are they actually doing day to day? And are they special, or is it a crowded market?
Well, their core business operates in a very specific niche. They design, build, and manage Discord communities, primarily for brands and influencers. However, the company doesn't really report significant competitive advantages in its filings. There's nothing proprietary jumping out. In fact, the filing highlights intense and increasing competition. They mention large digital agencies, specialized tech providers, and, crucially, low barriers to entry. That means it's pretty easy for new competitors to jump in and do something similar.
So no secret sauce.
Right. There's no real indication of sustainable differentiation. Not in their tech, not in their client relationships from what's reported. And that's key when you're thinking long-term viability, potential for growth.
Okay, so we've laid out this picture. Challenging financials, modest growth at best, ongoing losses. That naturally leads to the question, how is the market actually valuing this company? Does the stock price reflect these issues?
That's where it gets really interesting. It raises this big question about market perception versus the underlying value, right? Asset entities currently trades around $5.59 per share, gives it a market capitalization of about $49 million. Now, because they have net losses, there's no meaningful PE ratio, price to earnings. You can't calculate one. But the price to sales ratio, comparing the stock price to revenue, it's over 42 times. 42.
Wow, 42x sales.
Yeah.
How does that stack up?
Well, to put that in perspective, your typical digital media, maybe services peers, they usually trade somewhere between 2 to 6 times trailing sales. So 42x isn't just like severe overvaluation based on current performance, it strongly suggests the market is pricing asset entities for some massive future growth that, frankly, its current Discord business probably couldn't ever realistically achieve on its own. It's like the market's placing this huge bet purely on something else entirely.
Yeah, that 42x figure, it just sounds almost unbelievable for a company with those kinds of fundamentals we just discussed. Is there any scenario where a multiple like that could make sense just for their existing business? Or are we definitely talking about a premium based on something totally different?
For the existing business, almost certainly not. No, it just doesn't compute based on the numbers. And look, the stock also trades at a significant premium to its book value per share. So its market value is way higher than its accounting value, assets minus liabilities. There's no credible public discounted cash flow analysis you can do either because of the negative free cash flow and just the high level of business uncertainty. So yeah, relative valuation, it clearly highlights this extreme premium the stock commands compared to sector norms. Especially when you remember it lacks positive EBITDA, lacks net income. The market is definitely looking beyond their current operations here.
It really begs the question then, doesn't it? If the fundamentals look so shaky and the valuation seems so stretched, how has the stock actually behaved lately, especially with all this buzz around it? This is where it gets really interesting, I think.
Oh, absolutely. The way asset entities stock has been moving recently, it really tells a story. The price action is quite telling. Look at this. It surged from a range between, say, $3.50 and $4.80 back in August of this year, 2025. Then, bam, it jumps to $5.59 on August 29th. That was a single-day gain of over 16%.
16% in one day.
Yeah. And this kind of abrupt spike, you often see that in thinly traded, highly speculative stocks, where just a little bit of news or maybe momentum trading can create these really outsized movements because there just aren't that many shares changing hands easily.
Okay, so for traders who are watching the charts, what are the key technical levels they should be watching? And what do those indicators actually, mean for what might happen next?
Well, looking at the chart, support seems apparent around the $4 mark. That's a level where buyers have stepped in before. Short-term resistance, kind of a ceiling the price has struggled to break through, looks to be around $6.20. That was a high point hit in late August. Now, the stock is currently trading above its 50-day moving average. That average is around $4.40. So technically, that signals a bit of an uptrend, short-term anyway.
So some positive technical signals.
Some, yes. But the 14-day relative strength index, the RSI, that's a momentum indicator. It recently climbed above 70. Generally above 70 implies short-term overbought conditions. It suggests the run-up might have been too fast, and it points to a potentially elevated volatility ahead. Also, the MED, another momentum signal, it did cross bullishly, but the overall pattern, it fits that classic low-float momentum speculative characteristic. What that means is, because there's a relatively small number of shares easily available to trade, the stock is highly susceptible to these wide intraday price swings and potentially rapid reversals. It's a very volatile setup.
All right. Now let's finally talk about the elephant in the room, the merger. This seems to be the main driver for pretty much all the recent activity and the sentiment around the stock, right?
Yeah.
What's the big news here? And just how dramatic is this strategic pivot they're planning?
This is absolutely the pivotal point for asset entities. Huge news. On August 27th, 2025, they filed an 8K. That's a report companies use to announce major events shareholders should know about. And it announced this proposed merger with a company called Strive. Crucially, this merger isn't just a small deal. It's set to completely transform asset entities. The plan is to pivot from what they do now into a public Bitcoin treasury company. And they've announced over $1.5 billion in committed financing for this new strategy.
$1.5 billion.
Yeah, big numbers. And importantly, the SEC declared their registration statement, the Form S-4, effective back on August 22nd. That cleared a major regulatory hurdle. The shareholder vote is now set for September 9th, and apparently over 40% of shareholders have already committed support, which shows pretty strong internal momentum for getting this deal done.
So the plan is to basically become a pure-play public Bitcoin treasury proxy.
Yeah,
that's like a complete identity transplant from managing Discord communities. Yeah. But what are the risks that come with such a drastic change, especially moving into an entirely different, and let's face it, highly volatile sector like Bitcoin?
A complete identity transplant is a perfect way to describe it, and the risks are significant. The 8K filing itself emphasizes material risks, things like the potential for the deal to just fall apart, be terminated, significant challenges in actually integrating the operations of two very different businesses. There's also the risk of possible legal proceedings, cost overruns, you name it. Ultimately, the success of this whole pivot hinges entirely on flawless execution, which is tough, and on robust market adoption of this new Bitcoin-centric strategy. That's by no means guaranteed. It's a massive undertaking, frankly.
Okay, that makes sense. But what about insider sentiment? The people running the company. If this is such a potentially transformative, amazing opportunity, why would executives be selling shares right now?
That's a really astute observation. And yeah, the insider selling has been a notable signal. It raises eyebrows. There was a Form 144 filing. That's what insiders file when they intend to sell restricted stock. It disclosed a proposed sale of over 20,000 Class B shares by an executive. That was filed on August 27th, 2025. And that followed a prior, pretty substantial sale of 30,000 shares back in June.
So insiders are heading for the exits.
Well, substantial selling like that is generally considered a negative signal, right? It potentially reflects on executive confidence in the company's future prospects,
Yeah.
especially right before such a supposedly transformative event. It definitely makes you wonder why they're cashing out if the future is supposedly so bright.
And it seems the broader market, or at least a part of it, is picking up on this skepticism too. You mentioned short interest soaring earlier. What does a 458% increase in short interest really tell us?
Absolutely. It's a staggering number. By the end of May, going into June, short interest in asset entities just exploded, up 458%. Now, short interest, that's the number of shares investors have borrowed and sold short, betting the stock price will actually fall.
So a lot of people betting against it.
A significant number, yes. It signals pretty strong skepticism from a notable portion of the market, or maybe just an anticipation of more volatility as these merger deadlines approached. Either way, it's a strong indication that many traders are betting against the stock, maybe seeing the current valuation driven by the merger hype as unsustainable.
Okay, so the stage is definitely set for a pretty dramatic next chapter here. What upcoming events should we and our listeners be watching closely? What could really move the stock, for better or for worse in the near future?
Right, near term. The absolute critical date is September 9th, 2025. That's the shareholder vote on the Strive merger. The outcome there, completion or cancellation, that's going to drive substantial volatility, no question. After that, we've got projected Q3 earnings likely coming out sometime in November. That'll give a glimpse maybe into the legacy business or merger costs. There's also potential inclusion in ETF rebalances around October 1st. That could introduce new flows of institutional money, maybe prop up the price or not. And then around November 1st, we'll see institutional equity filings. That'll show us which big investors, hedge funds, etc., are holding the stock, maybe increasing or decreasing positions. Shows their confidence levels.
Got it. So those are the known dates. What about the whispers and the wild cards? Are there any longer-term catalysts or maybe speculative rumors flying around that we should be aware of? Things that aren't official yet.
Sure. Longer term, if the merger completes successfully, then positive catalysts would be things like, well, actually executing on those strategic partnerships with Strive, showing sustainable revenue growth from, say, new contract wins related to the Bitcoin strategy. As for rumors, you know how market chatter goes. There's some suggestion that asset entities in Strive might accelerate their Bitcoin purchases beyond that initial $1.5 billion commitment. Maybe try to front-run rivals entering the Bitcoin treasury space.
Interesting.
There's also some lingering speculation about expanding their TikTok Shop partnership, which relates back to their original business, oddly enough. And conversely, you hear unconfirmed whispers about potential merger delays or even key executive exits if the integration process turns out to be really rocky. These are just rumors, of course, but they definitely influence market sentiment day to day.
Okay, so beyond just the merger drama and all this speculation, what are the really big overarching risks you see for asset entities? If someone listening is thinking about putting money into this, what are the biggest red flags still on the horizon?
Well, look no further than the company's own filings. The latest 10-K, in the risk factors section, it explicitly states that substantial doubt exists about the company's ability to continue as a going concern. That's huge. They point to their limited operating history, those recurring operating losses we talked about. They face rapid competitive change in their original niche without strong proprietary tech or client lock-in. That dependence on equity financing, bringing up the dilution risk for existing shareholders again. That's explicitly stated as a persistent long-term issue. And then, of course, just the nature of the beast. Microcap stocks, like asset entities, are inherently prone to extreme price swings. And liquidity is a risk, meaning it can be hard to buy or sell shares quickly without significantly moving the price. And there's always the potential for market manipulation with these smaller stocks. It just adds another layer of risk you have to consider.
All right, so weighing everything we've discussed, the shaky fundamentals, the sky-high valuation relative to the current business, the technical volatility, the huge merger pivot with its own risks, the insider selling, the going concern warning, what's the bottom line for someone asking, is asset entities a good buy right now?
Taking all of this into account, the analysis from the sources we looked at presents a pretty stark investment thesis summary. They give it an overall rating of 2 out of 10.
2 out of 10, that's low.
Extremely low. It indicates extremely high risk, really, for both short-term trading and any kind of long-term investment. You've got an unprofitable company, lacking sustainable revenue momentum in its core business. It trades at a severe premium to its fundamental value. It faces substantial going concern risk, substantial dilution risk. Yes, the merger adds this layer of event-driven volatility and potential upside if it works, but the risk of the deal not completing or failing post-merger is considerable. And that insider selling just further dampens confidence, doesn't it?
So the takeaway is definitely not for the faint of heart, and probably not for anyone looking for a stable, long-term investment with a solid financial foundation. It sounds much more like a gamble than an investment.
Precisely. That's a very good way to put it. It just does not present an attractive opportunity for long-term investors who are seeking value or some measure of stability. Now, could highly speculative short-term traders try to play the volatility around the merger outcome? Maybe. But even the sources describe that as akin to event gambling, not really a sound investment strategy based on fundamentals.
That's a powerful distinction. Gambling versus investing. Thank you for helping us unpack all of this today. It's quite a complex situation. And it really highlights a fascinating tension, doesn't it? For you, our listener, how do you balance a company's current, pretty challenging fundamentals with the allure of a really bold, potentially transformative strategic pivot, like becoming a Bitcoin treasury? What does this specific situation with asset entities tell us about the broader market's appetite right now for high-risk, event-driven speculation, especially when it's tied to a powerful narrative like cryptocurrency? It's definitely something to ponder as you navigate your own investment decisions out there. We certainly hope this discussion has given you a clearer understanding of asset entities and the factors at play. We'll be back soon with another analysis of your sources. Until then, stay curious and keep learning.